Welcome all of you to today's session. Today, Glenn Strack, who's one of our senior implementation consultants, is going to present an exciting session that covers how to configure various kinds of budgeted activity that has a complex balance sheet impact and effect on cash flow forecasts based on your budget. This is a follow-up webinar to a more introductory one that we did a few months ago. Glenn will make sure to tell you about that introductory one too, but this is, like I said, a follow-up to that one. Now, for some housekeeping details, we've enabled support for closed captions. Today, we're using Zoom's Q&A for questions. Please post any questions there. We will follow up individually after the session if we need to do that. And just as a reminder, Martus offers several subscription levels. Our cash flow forecasting is available only at the enterprise level. This webinar is all about cash flow forecasting. So if your organization isn't yet on enterprise, this webinar means it's a great opportunity to preview this functionality. If you have questions about your organization's subscription to Martus, just drop a question in the Q&A. As always, we are recording this. We will send the video and PowerPoint to all registrants tomorrow. And lastly, just a note about our knowledge base. This webinar will be added to our knowledge base. Glenn will also be pointing out other documents about our cash flow forecasting module that are extremely helpful and that you will want to bookmark for reference. Unlike some other parts of Martus, the cash flow forecasting configuration can get pretty complicated, and so we want to make sure that you have all of these documents at your fingertips to help you with this. Now, I'm going to turn this over to Glenn.
Join me, welcome everyone. Join me as we take a journey into cash flow forecasting, starting with the life cycle of a fixed asset purchase. Cash flow is a hot topic in both nonprofit and for-profit circles. At Martus, we provide the tools to create a projected balance sheet and statement of projected cash flow based on your Martus budget. Let's dive in. Our November 2023 webinar covered cash flow basics. It walked through cash flow setup and the basics of how to create your projected balance sheet and statement of projected cash flow. Here is a clickable link to that webinar. Today's webinar builds on that. Even if you have not seen the first one, it is okay to watch this one. You can go back and watch the setup webinar later. Martus loves your feedback, and we listen. As a result, we have made the cash flow forecast and terminology changes that you see on your screen. The most significant of these relates to the time of transactions moving to cash. For example, 90/10 on an accounts receivable means 90% is collected in the month of the transaction and 10% in the following month. We now call this amortization schedule. Today, we dive deeper into cash flow with a demonstration of Global SPW templates. These templates provide both practical and advanced cash flow capabilities. To demonstrate, we'll walk through the cash impact of the life cycle of a delivery van. But that is not all. We'll also demonstrate a couple of other useful cash flow templates. Buckle in. Now let's head over to Martus to drive through some cash flow functionality. Today, as I mentioned, we'll be walking through the life cycle of a delivery van from loan purchase to sale. This incorporates a lot of cash flow functionality. Some of the basic aspects of cash flow, such as loan interest payments, could have been easily handled directly in the budget on a budget worksheet. But for the purposes of this demo, we will run everything through a global special purpose worksheet. Note, we are starting with a blank entity so you can see the cash and balance sheet impact of each cash flow entry. Our first stop on this journey is taking out a loan. Let's head over to the Martus knowledge base to see what guidance it provides. From the knowledge base, we're going to scroll down and you see we have a section just for cash flow forecasting. We're going to click on that. Here you see two options, cash flow forecasting and cash flow examples. First, cash flow forecasting. This section covers a lot of the basics we covered in our November 2023 webinar. It lays out the groundwork for everything you do in cash flow forecasting. Rest assured, when implementing cash flow forecasting, your Martus implementer will take you step by step through the Martus setup and functionality. Second, cash flow examples, and there's a lot in here. In this section, there is a wealth of cash flow forecasting knowledge. Since our first cash flow entry will be opening up a loan, let's explore the example. So we scroll down here and we see opening a loan, and we will use opening a loan template. For each template example, we provide a write-up, screen prints of the expected setup, and the impact to the balance sheet. My suggestion is that you lean on these examples. They provide great insight into the proper setup of a variety of cash flow forecasting templates. Now, I think it's time that we head over to a global special purpose worksheet and budget for our loan. In the interest of time, we have pre-configured some data, but we'll enter budget amounts as we explore each global SPW template. So we're going to head over Planner, Special Purpose Worksheets, and we're going to edit the cash flow shoreline. So all the work today we're doing is in the shoreline entity, but we're going to edit this shoreline template, or shoreline global SPW, I should say. Here we see we're going to start with the loan. Now, a new loan is not part of the planner budget because there is no P&L impact. It increases a liability account, in this case, notes payable, and the offset is cash. No amortization is needed since we're hitting cash directly. We'll use a global SPW cash flow forecasting template called opening a loan. So let's walk through that. You see, once you have the cash flow turned on, you have 3 tabs: info, values, and cash flow. Now, before we dive into this, let me just reiterate, the impacted accounts are a debit to cash and a credit to notes payable. So on the info tab, we click post to balance sheet only. Now you see we have 2 options. If you had a P&L impact, as we'll see later for some other transactions, you would click post to worksheet, post to budget worksheet. In this case, it's balance sheet only, so we're posting to the balance sheet only option. The option you choose will determine the templates, the cash flow templates you have to choose from. So we'll click to post balance sheet only. We're going to go to the values tab. We enter the loan amount in the month taken, which in this case, we're borrowing $75,000 in February. Now we're going to go to the cash flow tab, and we see a list of templates. A lot of options here. We'll hit a lot of these today. But right now we're doing opening a loan, which is to increase a loan amount. We select open a loan, of course, and select the appropriate liability account, in this case, notes and loan payable, and this is for the shoreline entity. So I'm going to go ahead and hit save. Now I do want to make the note that there is no need to post to worksheets since there is no P&L impact on this transaction. It's all balance sheet. Now let's build a balance sheet impact. So let me flip over there. Under Enterprise, you see Balance Sheet Impact. Balance Sheet Impact is a foundation for the projected balance sheet and statement projected cash flow. It pulls all the data in. So we're going to go ahead and build this. And one of the nice features that I like on this Balance Sheet Impact is I don't have to go to View Task Progress to see when it's done. It shows that it's building. So I'm just going to refresh my screen. And once I see the date timestamp, I know it's complete. And I know exactly when it was completed. And there it is. There's our date timestamp. We know it's done. Now we have this optional balance sheet impact report. And this gives a lot of great information, allows us to drill in. So let's take a look at this report. And I'm going to filter it by shoreline. And I'm going to hit load. Now it shows our notes and loans payable. And it shows that $75,000 balance sheet impact in February. Now we're not going to drill in this time. We will on a lot of the future transactions. Instead, we're going straight to the balance sheet. So under Enterprise, we have our projected balance sheet, and I'm going to go ahead and load that, and we're going to click on Shoreline. So let me draw your attention. So we have the impact on cash in February, $75,000. We have our operating cash, $75,000, and since it's a balance sheet, that carries on through the year. And then down in the liability and equity section, we have our offset in notes and loan payable. Very nice. Let's take a look, our first look at a statement of projected cash flows. And we'll hit load on this. And of course, we're going to go to Shoreline since that's where we're doing all our work today. And we'll go down to the financing activity. So you see, obviously, we have operating, investing, and financing. In financing, we see the February $75,000 impact on cash. Very good. Let's go back to our global SPW. Next, we need to budget the loan principal payments. A loan principal payment only impacts balance sheet accounts. We will use the loan principal payment template. The specified values debit our notes payable account in the month in which they are assigned. The offset is a credit to another liability account, in this case, accounts payable. This is amortized away from AP according to our cash flow amortization. The impacted accounts, once again, are a debit to notes payable, a credit to AP, and then AP will be amortized away to cash. So let's take a look. Loan principal payments. On the info tab, once again, this is balance sheet only impact. So we post to the balance sheet. We're going to go to the values tab. Now, we've been told by the bank that our payments will be $1,500 per month starting in March. So we're going to use our budget widget. We're going to start in March, and we're going to put in our $1,500 preview. Now, as I mentioned earlier, I pre-populate some of this data just to save time so we can get through more material. Now we're going to the cash flow tab. This time our template is loan principal payments, and we see the description to decrease the loan amount with payments from the offset account. Now, this loan principal payments serves dual purposes. So right now we're going to use it for our monthly payment. Later, we're going to use it to close out our loan. But for now, we select loan principal payments. The loan account, which will be decreased on a monthly basis, is loan and notes payable. Our offset accounts AP is going to be increased each month, but we've chose to amortize it in the month of the transaction, which is month 0. Now, in case you're not familiar with our amortizations, we have a lot to choose from, but you have complete control to create whatever amortizations that you want or what you need for your organization. So in this case, I'm choosing it's going to be amortized in the month it gets hit, and the location or entity is Shoreline. I'm going to hit save. Once again, no need to post a worksheet since there's no P&L to hit our worksheet. So we are going to go to our balance sheet impact. We're going to build it again. Remember, this is required before we run our balance sheet, projected balance sheet and projected cash flow. So I'm going to go ahead and build it. Once again, it shows this building. I am going to hit refresh. Once I see that date and timestamp, I know it's complete. And then we're going to go ahead and run the optional balance sheet impact report again to see some of the detail. So I'm going to filter this by Shoreline, and I'm going to hit load. All right, so here, it's amortized in the month it is hit. That's why the balance is 0. I'd like to drill in and show you behind the scenes what's going on. So I'm going to click the amortization option, brings up another tab, and in here you can see the AP of $1,500 each month. You can see it gets amortized to cash in that very same month, and the AP balance is 0 by the end of the month. Very good. Let us now run the projected balance sheet. So we'll go to Enterprise, projected balance sheet. We're going to hit load, and we're going to Shoreline. Now in here, we are seeing that $1,500 cash impact each month on our operating cash. Down at the base in the liabilities, we see the balance of notes payable decreases as cash is paid out. Very good. Well, let's look at the projected cash flow and look at the impact on that. And we're going to hit load. Of course, we're going to Shoreline. And in here, let's go to the base. In the finance and activity, we can see that as that loan principal is paid each month, it's impacting our cash at the end of the period. So a very nice picture of exactly what we're projecting in the future. Of course, we'll also need to pay interest on the loan. Loan interest is usually budgeted on a Martus budget worksheet with other P&L budget lines, and the cash flow can be ran through that. But in this case, it is not in our original board-approved budget, so let me show you how to run it through a Global SPW. Either way, it will impact the net gain loss line on the projected balance sheet. It will be offset by an increase to liability accounts such as AP. In this case, we will amortize it in the month it hits the balance sheet. The amortization is determined by the cash flow amortization. So just to reiterate, the impacted accounts are a debit to interest expense. We use banking fees for our environment, and a credit to AP, which we're going to amortize to cash. So let's take a look at loan interest. And on the info tab, this time we choose post to budget worksheet. Because we chose that, there's 2 implications of that. Number 1, we're going to see a different set of templates when we get to the cash flow tab. Number 2, we now need to choose the worksheet we want to hit and the GL account, the P&L account that we want to hit on our worksheet. So once again, like I said, we hit interest expense on our banking fees line. I'm going to the values tab. And per the contract, we will be paying $400 a month in interest expense. We're going to enter that with the budget widget, just like that. Next, let's head over to the cash flow tab. Now we see a different set of templates. The standard income and expense template is basically used where if you could have put it in originally in your budget worksheet and ran it through cash flow that way, you can also, and then you didn't, instead you can put it here because the standard income expense template is for budget lines. They impact only one balance sheet account. So that's perfect for our example, right, for our loan interest. So in this case, we select an offset account, which is accounts payable. And this default is actually set up in the original setup under setup accounts where you have a default balance sheet account for every P&L account. In this case, it was AP, but we could override that here if we needed to. And then we choose our amortization schedule. This default is also set up under setup accounts for our bank fees account for every P&L account, but we can override that also. But in this case, we're going to use the default, and I'm going to hit save. Now, what's the difference here is because we have a P&L account, we want to post it to our worksheet. Simple as that. Now, let's go ahead and build the balance sheet impact so that that data will flow to our projected balance sheet and cash flow. They close. Once again, looking for that date and timestamp. And now this time, I've got a tip for you when you run the report. Remember, this report is optional, but it provides a lot of great details where you can drill in. And we're going to filter this like we have to Shoreline, but I want to introduce you to another filter, the GL source account filter. I have found this filter to be very valuable to target to the data that I want to see, because over time you have a lot of entries going into this balance sheet impact report. So I'm going to use this GL account and filter to 5,400 bank and fees, our source, and hit load. And this way we'll see only what we need to see. So here we see the AP. Let's click on the amortization. So the balance is zero. That's because we're amortizing in the monthly hits. And we're going to look at the amortization. So here we see the $400 per month in AP. It gets amortized to cash in the monthly hits, and then your balance is zero. So loan interest amortization from AP to cash occurs in the month of the transaction, in this case, based on our amortization selection on the cash flow tab. Let's take a look at the impact from the balance sheet, projected balance sheet perspective. Hit load, select the entity we want to focus on. Now the cash impacted, you see $1,900 a month. Well, that's $1,500 loan principal payment and $400 per month in loan interest. Down below, we can see our operating cash decreasing. And down to base, I want to draw your attention to the gain or loss. For the first time, we see an impact down there because we're hitting $400 per month on the banking fees. Let's look at the impact of the projected cash flows. And I'm going to hit load and Shoreline. And here we see the $400 gain loss having that impact on your operating activity cash, that cash impact. All right. Next, we've got everything set up, but we've yet to buy our van. So now that the loan is set, it is time to purchase our van. When a fixed asset is purchased, it only affects the balance sheet. The values entered will increase asset accounts such as fixed assets. The payment increases a liability account such as AP and is amortized away according to the cash flow amortization. So our impacted accounts are a debit to fixed asset and a credit to AP. AP is going to be amortized away to cash. So let's look at the purchase of our vehicle, our van, and this is balance sheet only. Go to the values. The vehicle purchase is $75,000 in February. And we'll go to our cash flow tab. In this case, we're selecting fixed asset as our template. So to increase a fixed asset account with payments from the offset account, notice there's an option for is sale. We will use that later. But right now we're going to choose fixed asset. We're going to ignore is sale, and we select our fixed asset account, which for us is fixed assets to be capitalized, our offset account, our amortization schedule. So this time we're going to do something a little different. We're going to amortize 90% in the month of the transaction and 10% in the following month. Of course, you could choose whatever amortization schedule makes sense for your organization. And I'm going to hit save. No P&L, so no need to post the worksheets. No P&L impact, I should say. Next, let's run our balance sheet impact. We're going to build it, refresh the screen, looking for that date timestamp, and then we're going to run the balance sheet impact report. And in this, we're going to filter to the location shoreline, and we're going to filter our GL source account to our fixed asset 1650 and hit load, really focusing on the data that we want to see. So here we see the fixed assets to be capitalized. There's that 7 February. I'm going to hit the amortization. Here we see, when this comes up, that 90% amortized in the month of purchase, right here, 90% in the month of purchase, and 10% in the following month. Looking at our balance sheet, hit load, we're going to filter, and let me draw your attention to the fixed asset to be capitalized. There's our purchase, $75,000 value to start, and down below, it's adjusted by any unamortized portion. And we see our notes and loans payable down there. Let's go to the cash flow, load, filter. And here I just want to draw your attention to the fixed asset purchase impact on cash of negative 75,000. And we can see right below that the 10% amortization going on. Now, it is best practice to depreciate our new van. This can be budgeted directly on the worksheet SPW or Global SPW. In our case, we're going to do it on the Global Special Purpose Worksheet. And if using a Global Special Purpose Worksheet line, the template should be the default standard income expense since this transaction only hits one balance sheet account. The result will be an increase in depreciation expense and a credit to accumulated depreciation, resulting in a negative balance for accumulated depreciation on the projected balance sheet. We will use the 0-0 no amortization option since, as you know, there is no cash impact on accumulated depreciation. So our impacted accounts will be a debit to depreciation expense, no cash impact, and a credit to accumulated depreciation. Let us come on down to our depreciation. In the info tab, we're going to post to budget worksheet option. Since there is a P&L impact, therefore we need to put the worksheet, the depreciation expense account, and we're going to values. The depreciation is $1,250 per month starting in March. So 1250 preview, and we're going to move to the cash flow. Once again, we use the standard template when only one balance sheet account is impacted. We're going to look at some of these other templates in a bit. And with this, our offset account is accumulated depreciation. Once again, that's a default set up on the depreciation expenses setup accounts, but it could be overridden here. And the amortization schedule is no amortization. We're going to go ahead and use that default is what I should say. And we're going to hit save. We're going to come down. We're going to post that to the worksheet since we have our depreciation expense involved. And we want that to hit the budget worksheet. Now let's build our balance sheet impact. Build a balance sheet impact. We're going to hit close. We're going to hit refresh. And once again, we're going to run the balance sheet impact report. We're going to filter it, and our GL source account, in this case, as you already know, is $59 depreciation expense. And we're going to hit load, and here we see the impact, the balance sheet impact to accumulated depreciation. And it's $1,250 per month, and no need to drill in on this one. It's pretty straightforward. We're going to go straight to our projected balance sheet to see the impact on shoreline. So load and filter and come down to our accumulated depreciation. And quite clearly, we see that increasing by $1,250 per month. And we see our depreciation expense as part of the gain loss at the base of the balance sheet. Now heading over to the projected cash flows and hit load and shoreline, there is no cash impact because this is depreciation expense, accumulated depreciation, they offset each other, resulting in no change to cash, no additional change. Let's head back over to our Global SPW, moving right along. I have some bad news. Later in the year, we need cash more than we need our van. Now, our team loved the van, but it's time to say goodbye, so we sell it for $50,000. Now, when a fixed asset is sold, there is no P&L impact. The result will decrease fixed assets and increase a receivable account such as AR. It is amortized away from AR according to the cash flow amortization. In this example, we're going to use 100% in the month it was sold. The fixed asset template is used. Be sure to check the checkbox to indicate this is a sale. We pointed out earlier, and we'll look at it again. So there's a lot going on here. Let's talk about the impacted accounts. A debit to accounts receivable, which will be amortized away, that's $50,000, which is the sale price. A debit to accumulated depreciation for $10,000, that's to remove accumulated depreciation from the books. That's the amount that's built up so far, year to date. A credit to fixed asset to remove the original purchase price. The original purchase price is $75,000. Now, temporarily, the difference from all that hits cash. On our next entry, we're going to remove that $15,000 cash impact and replace it by a gain loss. So we'll see that in the next entry. So let's look at this sale and how this is set up. So on the info tab, balance sheet only, because we're hitting AR, accumulated depreciation, fixed assets, and cash. On the values tab, we sold the van for $5th November. So we're going to go ahead and put that $50,000 in and go to the cash flow tab. Here we use the fixed assets. A lot going on here. And once you choose is sale, we have an explanation of how to enter this. And I just want to show you the difference between is sale and not a sale. So we used it before on the purchase. Now we're using it for the sale. So we're going to choose the fixed assets account, our $1,650, the purchase price, and we need this purchase price so we can back it out of this account. Then the accumulated depreciation account, and we need to know what's the value as of the month of the sale is $10,000, so we can back that out. Right here, that we must enter the sales price on the value tab in the same month that we put here. So November, on the values tab, we put the $50 in the same month. The offset account is AR, so the cash from the sale goes to this offset account. Amortization to cash, we're going to do the month after the sale, and our location is Shoreline. So let's hit save. Once again, no need to post the worksheets. It won't hurt, but there's no need since there's no P&L account involved in this sale. So we're going to come over here. We're going to, as you're getting very good at, we're going to build the balance sheet impact. We're going to refresh our screen, see the date timestamp, and then we're going to run the optional balance sheet impact report. We're going to filter to Shoreline so that we can see the whole picture. I'm not going to filter the GL source account, and we're just going to hit load. So a lot going on here. I want to point out in the fixed assets to be capitalized. On this report, you can see where it was purchased in February and where we removed it in November. And same idea with accumulated depreciation, etc. Let's click on the amortization for the AR. So you can see the AR comes in and we amortize it 1 month later, but let's see in the amortization schedule as this comes up and we see the $50,000 in AR in November amortized out in December. Next, we'll come back here and let's click on accumulated depreciation. Let's see what happened with our accumulated depreciation account. So I'm going to click directly on that. Remember, anything in blue is drillable on Martus. So in this case, we're going to clearly see the accumulated depreciation going in, that $1,250 per month, and the accumulated depreciation year to date of $10,000 is removed right there. All right, very nice, very nice. So let's look at the projected balance sheet under the Enterprise tab, and we're going to hit load. We're going to filter by Shoreline. Once again, there's a lot going on here, but I do want to point out a few things. There's our $50,000 that gets amortized out. I want you to note that the $75,000 fixed asset to be capitalized has been removed from the books. I want you to note the accumulated depreciation change. There's the $10,000 that gets removed. And there's no change in this case in liabilities and equity from the sale of the fixed asset. Now for the cash flow, and we're going to hit load, and we're going to Shoreline. And here we have our accounts receivable, fixed asset to be capitalized, and accumulated depreciation all having an impact on cash. And you can see the $50,000 in AR coming in and out. We can see the fixed asset sale, so the purchase and the sale, and then the accumulated depreciation impact on cash. Very nice. Coming back over, what we haven't booked yet is the gain or loss on sale. So the net impact from the van sale is a loss. Any gain or loss on sale will require a separate posting. This line may be entered either on the SPW or on a budget worksheet. As mentioned earlier, we use a standard income expense template on any SPW line that uses a P&L account and impacts a single balance sheet account. This could have been posted directly, this gain or loss could have been posted directly in the P&L budget, but we added it to our global SPW since this sale was not in our original P&L budget. So our impacted accounts are gain or loss on the sale, and the offset hits cash directly. Therefore, there is no amortization. Now, no, I didn't say debit or credit because we don't know. The debit on the gain, loss, and sale and the cash just depends on whether this is a gain or a loss. So let's go ahead and click on gain loss and take a look at the steps. So this posts to a budget worksheet because we will be hitting the gain loss on fixed asset account, P&L account. On the values tab, I'm going to go ahead and put this in. It's a loss of $15,000. But I do want to talk through this. I'm going to expand this a little bit. So where did we get the $15,000 loss from? Well, we had a $75,000 purchase. We accumulated depreciation at the time of the sale was $10,000. So the value of our van at the time of the sale was $65,000, the 75 less the 10. We sold it for $50,000. So the $1,000, we only sold it for $50,000. So we sold it at a loss of $15,000. All right, let's go to the cash flow tab and standard income expense template, as I mentioned earlier. And we are hitting cash directly, so there is no amortization. As a matter of fact, if you hit cash directly, we don't allow you to change that. It's always no amortization. So we're going to hit save. We're going to post to the worksheets. Now there's one last, and I guess we probably should go ahead, run I changed the balance sheet impact, and we're going to run it. Close it, refresh it, look for that date timestamp, and then we're going to build the balance sheet impact report. And there we go. We're going to filter shoreline. Our GL source account this time is our gain loss account. So we can focus in on what happened in that last transaction. And I'm going to hit load. And here's our operating cash. So we can see that 15,000 impact on cash. All right, let's just go back to our global special purpose worksheet. Now it's time to pay off the loan and thereby reduce our notes payable. The impacted accounts will be a debit to notes payable, which is going to set it back to 0. And a credit to AP, which will be amortized to cash immediately in this case. So let's go ahead and click on this. In this case, balance sheet only. We'll go to values, and we have $60,000. So where am I getting that number from? We originally borrowed $75,000 for the van. On the projected balance sheet, we see that we still owe $63,000 at the end of October after 8 note payments of $1,500 a month. Here we enter the payoff amount with $60. We move to the cash flow tab. Remember that we use loan principal payments to set up the original monthly payments. Well, in this case, we're going to use it to eliminate the notes payable or to pay it off. So the offset account or the loan account is notes payable. The offset account is accounts payable, and the cash flow we're amortize that in the month that happens. And we're going to hit save. Let's build the balance sheet impact. Hit close. Refresh. Look for that date and timestamp, and then we're going to load the balance sheet impact report, and we're going to filter it by shoreline. And the GL source account is our notes payable, and we're going to hit load. The $64,500 notes payable balance in November, and it would be $63,000, but there's still $1,500 a month hitting it each month, which we're going to talk about that in just a moment. Now we're going to go to our projected cash flow. No need to look at the balance sheet in this case. And we're going to hit load, and we're going to go to shoreline, and down here we see the $64,500. All right, one more step here, and then we can move on to some other topics. We need to remove the future month interest payments, principal payments, and depreciation. So you'll see those sitting here in these final 2 months. We need to back these out in the future months of November and December, because originally we had created these budgets for them, and now we need to back those out. So let's just do this real quick, starting with the loan principal payment. And here I'm going to say starting in November, 0, and preview, and hit save. We're going to do the same thing with the loan interest. Back out that $400 a month, start in November, put 0 and hit preview. And then lastly, the depreciation, you see that's still hitting, and starting in November, 0 and preview and 0'd it out. In reality, I would remove those descriptions also. In the interest of time, I'm going to keep moving forward. Now, this did have those 3 that I removed. There was a P&L impact, so I'm going to post to the worksheets. Now, the life cycle of the van is complete. Let's take a few minutes to explore some other Global SPW cash flow forecasting templates, starting with prepaid expense and recognition. To configure our prepaid expenses, so I'm going to hit OK on that. And let's go to our special purpose worksheets. I'm going to hide the worksheet SPWs, and we're going to go to the prepaid. To configure prepaid expenses, we show when the payments hit the accounts payable and reflect the recognition of prepaid expense using the prepaid expense and recognition template. Our example illustrates a 12-month, $48,000 insurance expense that occurs in the first month of the fiscal year. We will recognize $4,000 per month for 12 months. Now, in your case, if the expense crosses a fiscal year, you would add another line to the SPW to recognize the carryover expense from the previous year. Of course, there are directions in the knowledge base. So the impact in month 1 is a debit to expense for the $4,000 insurance, a debit to prepaid for $44,000 future months, and a credit to AP for the $48,000, which will get amortized to cash. Months 2 through 12 are different. In that case, you're debiting expense for $4,000 and credit prepaid every month. So let's take a quick look at this. Prepaid expense and recognition, post to the budget worksheet. We're hitting the insurance expense. And what's the amount we're hitting it for? We're hitting it for $4,000 a month. And I'm going to hit preview. We'll go to cash flow. This time we are using that prepaid expense and recognition. And there's a lot of great information on this in the knowledge base. The prepaid account, the prepaid amount is $48,000, but the first month it'll go down by $4,000 to $44,000. Payment frequency, well, we're paying it all up front, but you could do quarterly or monthly. The first month is January. Offset account is AP, and the amortization, we're overriding the default and doing it in the month following. So we're going to go ahead and hit save. We're going to post to the worksheet. Now let's build the balance sheet impact. I just want to show you this real quick. Hit close. We're going to hit refresh. We're going to run the report with a source account of 5504 insurance. And of course, Shoreline. Source account 5504, so we can narrow the impact of this report. And here we see our prepayments going down by $4,000 a month, and we see our accounts payable being amortized in the month after the setup. All right, so let's move on. Let us talk about balance sheet transfers. It's another option. So we're going to come back here, and we're going to go to our special purpose worksheets, and let's hide the worksheet SPWs. Let's go to balance sheet transfer. Sometimes you need to move amounts from one balance sheet account to another. Depending on your setup, you may need to move amounts from a restricted balance sheet account to an unrestricted balance sheet account. Now that just depends on your setup. In our case, we need to transfer cash from our primary cash account to our payroll bank account. The balance sheet transfer template will allow you to choose a source account and a target account. So in this case, our debit will be to the payroll bank account and our credit to operating cash. So let's go ahead and set that up. On the info tab, it's balance sheet only. On the values tab, we're moving $5,000 a month. And on the cash flow tab, you see we selected balance transfer, and there's a write-up, of course. And we're going from the operating cash to the payroll cash, but it does not have to be cash accounts. It could be any balance sheet accounts, and we're going to hit save. Of course, no P&L impact. So if we were to quickly run our balance sheet impact, close, refresh, and then we're going to filter our report to our source account of operating cash for Shoreline and hit load, and you can clearly see that movement of cash. Very nice, very nice. All right, now let's talk about sometimes, so that was a case where if you're releasing your funds and you have your funds set up in the balance sheet account, you can move it around from restricted to unrestricted. Sometimes you have it set up in the P&L. I just want to bring this to your attention because I don't have time to show, but release of funds from restriction. So if you go to the knowledge base and you go to cash flow forecasting and you click on description and setup, there's a wealth of information in here. But if we scroll down, there is a write-up on release of funds from restriction. So I'll leave that for you to read up on. Let us know if you have questions. Lastly, before we hand this back over to Vanessa, of that and sales tax. So once again, we have an excellent example. So I'm going to show cash flow examples. I just want to bring your attention to this. That and sales taxes. We have a large write-up on this. We have, of course, our printouts. And then lastly, we are showing the balance sheet impact. So in essence, it's a debit to AR, it's a credit to sales, and a credit to taxes payable because there's taxes as part of that. And you can set it up to pay next month, the next quarter, etc. There's a lot of great options in here. I want you to know that this resource is here to help you walk you through it. And as always, our Martus support team is available to answer any questions that you may have. So I'm going to flip back over to our PowerPoint. Now, Vanessa, these webinars are a valuable resource with a lot of great information. What's coming up next?
Upcoming in June, Glenn will have another installment of our quarterly series that we call Watch Me Work. That is live with interactive Q&A. These interactive webinars target typical customer needs for those Martus activities that you do only infrequently, like starting a new budget cycle and getting started with budgeting personnel in a new year. We also have a slot in each year for a rotating topic. As you can see, this month we will take a dive into SPWs. Plus, we have a slot, the last one in the month, for end user training, and that's tailored to end users rather than admins. We do repeat this series periodically. We did one round in March. We're going to do it again in June and in September as well. You can choose which month to attend based on your organization's fiscal year start month and annual budgeting cycle. But even if you're not at the appropriate point in your annual budgeting cycle, you might want to drop in to attend that look at SPWs, or you might wish to have your end users attend the session that is targeted to them. In August, we're going to take a little bit different look at SPWs and do a deep dive into some of the more complex aspects of SPWs, including globals and formulas. Thank you very much for attending this session here. We certainly hope that you've enjoyed this peek at the new features of cash flow forecasting. Please reach out to your customer success manager at support@martussolutions.com if you have further questions. There's a few people that did drop questions in the chat, and we will be responding to you within the next day.